Hey everybody, my name is Justin. Today I want to talk about Foot Locker, ticker symbol FL. This one was a lot of fun to dig into. I've used the last few days to read their 10K, really dig into their financials, to really figure out what this company is all about and try to come up with a full stock analysis where I'm going to talk about the business overview. We're going to talk about some recent acquisitions that they made. We're going to do a 7-year financial review of this company. We're going to talk about their economic moat. Do they have a competitive advantage over their competitors? We're going to talk about risk associated with this company from how I view it. I'm also going to talk about what is the intrinsic value for this company and the expected return on investment I would expect to get for this company's stock price based on today's value and also future stock values as well. So let's just dig right into this. And first of all, let's take a look at a 5-year stock chart. And the stock has just been all over the place. You go back 5 years, it was around $80 a share back in January 2017. It got all the way down to $17 last year when a lot of stocks dropped. And then right now it's trading around $48 a share. But you can see there's been a lot of dips and there's been a lot of peaks as well for this company. And if you would have bought this stock back 5 years ago, you would have had a negative 28% return. So certainly way less than the market. But we're going to figure out, is this value at $48 a good value or not? So next up, let's just talk about the business and what they do. And this company mainly focuses and sells athletically inspired shoes and apparel. Foot Locker's merchandise comes from only a few suppliers, Nike being the largest by far. They have store names including Foot Locker, Champs, and Runners Point. Foot Locker operates in thousands of retail stores throughout the United States, Canada, Europe, Australia, New Zealand. They also have one franchisee in the Middle East and one in Korea. The company also has an e-commerce business selling through footlocker.com, Eastbay, and Final Score. The company has purchased 91% of their merchandise in 2020 from only 5 different suppliers. And this information is coming right out of their 10K. 75% of all their merchandise purchased in 2020 was from one supplier, Nike. Merchandise that is high profile and in demand is allocated by other suppliers based on individual store internal criteria. So you can see Nike being their biggest supplier by far. They have to have a really, really good relationship with that company. And Adidas is their second largest supplier. Next, let's talk about the stores that they have. And right now they have about 3,100 stores. And this is as of February 2nd, 2020. You can see that they actually closed more stores than they actually opened during that year, which is kind of interesting. They have 867 stores in the United States, 636 in Europe, 105 in Canada, 91 in the Pacific, 14 in Asia. They have 431 kids Foot Lockers, 46 lady Foot Lockers, 536 Champ Sports, 245 Foot Action, 81 Runners Point, and 77 Sidestep. Next up, let's look at comparable store sales. 2020 was a rough year. It was a rough year for a lot of retail stores just in general with the whole Rona event that happened. So they had negative store sales that year, or same store sales. You look at 2019, they had about 2% comparable comps. In 2018, they had about 2.7% comparable comps. Now, what's really interesting is the shift that this company has made from in the stores to e-commerce. So if you look back in 2019 specifically, they had about $6 billion in sales that were in the stores and about $1 billion that were e-commerce or direct customers. Right? 2020, completely different story. So they had about $5.5 billion in store and about $2 billion online. So it definitely begs the question, can they continue maybe going that direction and utilizing e-commerce to boost their sales? Certainly there are more higher margins if they were able to do that. They're headquartered in New York, New York. They have about a $5 billion market cap right now. They have 51,000 employees. They did about $9 billion in revenue the trailing 12 months. Their PE right now is 5. That is ridiculously low. I think I was looking this morning, it was like around 4.5. It's really hard to find any PEs, it seems like in this market, under 8, let alone under 5. Now we should probably talk about some acquisitions that they made here in the last several months. And I think this is important for the company because it could really push them in a quicker growth aspect. So let's just talk about these companies right now. So the first one is WSS. This company was founded in 1984. They have about 93 stores. Most of them are out in the west and southwest of the United States. They have 1,900 employees. For 2020, they did $425 million. Now, as part of a presentation that this company has made about these purchases or acquisitions, they think this company or this standalone brand alone can get up to about $1 billion in revenue in the future. Now, they say that's long term, so I'm not sure if that means 5 years. I'm not sure if that means 10 years down the road, but they feel very strongly that there could be upward trajectory on sales from this company. Next up is Atmos. And this company is actually in Japan, so they want to take a bigger international stage. And Japan is the 3rd largest economy in the world. Atmos was founded in 2000. They're headquartered in Tokyo, Japan. 300 employees, about $175 million of 2020 sales, 49 stores in total. But this is a way they can get into the Japanese market. Now we take a look at the summary for these acquisitions. WSS was purchased for about $750 million. Then Atmos was purchased for $360 million, so a little over $1 billion total, so about $1.1 billion between these two. Now the Atmos acquisition, additional purchase consideration potential based on achieving certain revenue growth and EBITDA performance targets. Both transactions, this is really important, both transactions were funded with the company's available cash. So this company didn't have to go out there and issue more shares. They didn't have to go out and finance and increase their debt. They did this purely from cash, which is absolutely incredible. So as of the last quarter, they had about $1.6 billion in cash. So their balance sheet is extremely strong. Both transactions are expected to be accretive to Foot Locker EPS in 2021. Both WSS and Atmos will maintain names as new banners within Foot Locker portfolio. Both these transactions are expected to close late Q3 2021. So these acquisitions are important to know about this company in general. All right, so now let's talk about economic moat. Does this company have a competitive advantage? And after digging into the company, I do think they have one moat, and that is a price moat. And the reason for that is they're able to get really strong margins even though they're a retail company. So a lot of retailers, I would say 3 to 5% for net profit margins, for example. This company gets in the high single digits. I mean, you're talking 7, 8, 9%. And the reason for that is a couple of things. So they have really strong supplier relationships. So Nike sells more shoes to Foot Locker really than anybody else. And so Foot Locker actually gets the first choice on new Nike shoes that come out. And customers know they can come to Foot Locker and get the latest and greatest Nike footwear along with Adidas and other apparel. And Foot Locker over time has been able to even raise their prices, and customers have been willing to pay for it. And they also have a high return on invested capital, which we'll go over later. Next up, let's talk about management. And the CEO is Richard Johnson. There's a picture of him right there. He's been with the company for a very, very long time. So he's been the chairman since May 2016. He's been the chief executive officer since the end of 2014. But you can see all the different titles that he has had with the store going all the way back to 2003. So he's been with the company for almost 2 decades. All right, so now let's talk about the financials, and we're going to do a 7-year review. There are actually 5 growth metrics I want to talk about. This one is a brand new one that I'm starting to talk about. But I talk about sales, per share, earnings per share. The new one is operating income per share, free cash flow per share, book value per share. So we're going to do a 7-year comparison. And then we're going to look at management effectiveness. How well does the company manage equity, manage debt financing, able to turn it into net income by return on equity, return on invested capital, and then also how much long-term debt does this company have and how long does it take to pay off that long-term debt based on free cash flow. And then we're also going to take a look at margins, gross profit margins, net profit margins, and then operating profit margins. So first up, let's talk about sales per share. And you can see it going up. It's going from $51 back in 2014 to about $84 sales per share last trailing 12 months. So this isn't a lot of growth, which we'll get to a annualized growth chart here in a little bit, but this is roughly 5 to 6% growth per year. So not a lot of growth, but is there. Next up, let's take a look at earnings per share. This one has been all over the place. So $3 back in 2014, dropping down to $2 in 2017, up to $4 2019, drop down again, and then huge, massive uptick. $9 a trailing 12 months. And a piece of that is that switch to e-commerce really boosted the business, really they were able to take advantage of higher margins. But I also took a look at their P&L too to see if there's anything going on. And there's a few things that stood out to me. So they had some gain on sales of investments here. They had some asset write-downs. They had insurance settlements. They had other unusual items going on. So specifically, I'm looking at 2020. So you have $186 million from gain on investments, 77 asset write-off, a lot of stuff going on. So I dug into the 10K to figure out, what this means, what's going on. And I certainly encourage you, if you're looking into companies and you're interested in a company, you're looking at stuff after the operating income and you see all this stuff going on, it's good to dig in to figure out what's going on. Are they one-time events and that sort of thing? So this is what it had to say from the 10K. So in 2020, they had impairment charges of $117 million, basically $93 million net of tax. And that was part of the asset write-off that we saw. Also during 2020, one of their minority investments that they ended up recording a gain from that. It's a non-cash gain of $190 million. They also recorded a $25 million tax charge. They recognized a tax benefit of $5 million in 2020. So there's a lot of stuff going on their income statement and their free cash flow. So a lot of this seems like it's just one-time events that shouldn't continue to happen. I guess they could. I mean, we saw about almost a $500 million adjustment to sales of assets, that was non-cash in the last trailing 12 months. So some of these things could continue to happen, but so it's just something just to be aware of. And so next up, we're taking a look at operating income per share, and this is something that's new that I like to take a look at. So this is EBIT, earnings before interest and taxes, and I kind of want to see what's going on with the company compared to earnings. And again, this one is kind of all over the place, and actually it's gone down quite a bit more than actually earnings from 2014 to 2020. Obviously, last trailing 12 months, again, they had a really big uptick. It had to do with a lot of the e-commerce business they were doing. All right, next up is free cash flow per share. And this has been going up. It's gone from about $3, almost $4 back in 2014, upward trajectory to about $6 per share here last trailing 12 months. Next up, let's take a look at book value per share. So this is equity of the company. It's also gone up from about $18 book value per share to about $32 here in the last trailing 12 months. All right, next up, let's take a look at ROIC, ROE. I want to see at least a 10% for each year or more, and I want to see some consistency, and we have not seen a lot of consistency. So it's been all the way up at 23% 2016, all the way down to 5% last year. A lot of this is driven by net income. So what this tells us is how effective management is at taking equity, shareholder money, also debt financing, and turning into net income. So if we specifically look at 2020, this 5%, that specific year, only 5% of the money that was given to them, they were able to turn into net income. So for every dollar that was given to them, only $5 turned into net income for the company. Return on equity's kind of been all over the place too. 11% in 2017, all the way up to 31% this past year. Now, as far as an average goes, it's well over 10%, which is great, but definitely a lot of fluctuations over the year from that. All right, so long-term debt, here I'm looking at how many years it's going to take for the company to pay off their long-term debt based on free cash flow. And this chart's kind of misleading because it looks like they have a lot of debt back here, but it's not the case. So 0.2 years, so barely any debt over the last several years. So 0.2 years in 2014 it took them to pay off their debt. Here today they have virtually nothing. They have a little bit, I think it's around $8 million, something like that, that's on their balance sheet right now, compared to $1.6 billion of cash on their book. So they can easily pay off their debt no problem based on their free cash flow. So they're in a really, really good shape as far as debt and cash. And shares outstanding, the company has been paying down their shares. So from 140 million shares 7 years ago to 103 here today. And they do have a $1.2 billion buyback program that is in place right now. And they've only used a small percentage of that. So interesting, as long as the shares stay, I think, well under $50 a share, it probably makes sense for the company to buy back shares in general. All right, so let's take a look at some profit margins here. And the first one is gross profit margins. And they've been going down. So from 42% down to 29% last year to around 33% the trailing 12 months. So that doesn't look very good. If we take a look at net profit margins, it's very similar to what we saw with earnings, all over the place. 7% 7 years ago, 4% 4 years ago, 12% the trailing last 12 months. So definitely not consistent whatsoever, but definitely, again, we can see with that e-commerce business, that has really helped net profit margins a lot. But also keep in mind the sale gain on investments that was a non-cash has also affecting this. So there's non-cash stuff going in here as well. So let's take a look at operating profit margins, because that gets rid of that non-cash stuff that's going on. Again, it hasn't been really consistent, and it's been going down. So 11% all the way down to 5% last year. Got back up to 11% trailing 12 months, so that's good to see. Hopefully they can keep it there, because certainly the last 6 years before that, it's been on a downward trend, which is obviously not a good thing. Now let's take a look at 8 key metrics that I look at. And if you guys follow my videos, I usually say 7 key metrics. But again, this operating income per share is a new one that I'm starting to look at, because that takes out a lot of the non-cash stuff that's going on after operating income. All right, so these first ones here are growth metrics. I want to see at least a 10% growth per year going out the last 7 years. Sales 6%, earnings -3%, operating income -8%, free cash flow 15%, book value per share 7%. So the only one that is a yes, that's 10% or more, is free cash flow. Everything else is a no for me. So we got 4 no's there. If we go down to return on equity, return on invested capital, we want to see at least a 10% average the last 7 years, 19% for ROE, 16% for ROIC, which is excellent. So those are yeses on both of those. So those look really good. Debt payoff, they virtually have no debt right now. It's less than 10 million. And so they can easily pay that off less than 3 years. So they have a yes there as well. So you're talking about 4 yeses and 4 no's. So from a growth standpoint, has not looked good for Foot Locker. They've kind of struggled in that area, being consistent. But as far as managing money, this management team has done a very, very good job at allocating the money that they've received and turned it into net income. All right, so now let's take a look at dividends. And this company has been paying dividends. And I will say in general, they are definitely shareholder minded from buying back shares and then also doing dividends. It was on an upward trajectory, and it has been. I think they've had roughly about 4.5% growth over the last 10 years. But they ended up stopping just for a short amount of time their dividends. And that's really important to note. So when a company starts having potential issues with cash, or something's going on with the industry or the economy in general, the first thing they do is usually cut back on share buybacks. And the next thing they do is dividends. And people always ask me when I do my valuations, why do I not estimate dividends? Why do I not estimate share buybacks? This is the reason for that. Companies, it's not guaranteed to continue paying out dividends, continue buying back shares. If companies are in trouble, those are the first things they cut. Now, they instituted the dividend back because the company got back on track. They looking pretty good last trailing 12 months. So I expect them to kind of get back to this level up here and upward trajectory. So that at least is looking good for right now. All right, so now let's talk about valuations, and I look at different trends. So the first one I look at is a PE historical trend. I also look at an acquires multiple, which is EV over EBIT, and then we're going to look at intrinsic value methods. We're going to get earnings per share, projecting that out the next 10 years to come to a sticker price today, a 10 cap valuation, which looks at owners' earnings and trying to get a value per share based on that, and then a discounted free cash flow model as well. So first up, let's take a look at the PE trend over the last really 8 years. And historically, Foot Locker has traded at a discount to the market. So on average, the market has traded around 15, 16 PE, where they've traded around 8, 9, 10 PE. So that's just important to notate, because even though they're trading around a 5 right now, which looks to be really cheap, it may not be as cheap as maybe some other companies because they've historically traded at below just the overall market goes. But I would say, an average P for them is probably in this range right here. But certainly looks like it might be good value based on historical numbers. Next up, let's take a look at acquires multiple. This is EV over EBIT or EV over operating income. And I just kind of like to see where they've been historically, because this basically, if you don't know what enterprise value is, it's taking market cap, which is total shares outstanding, times what the stock price is, and then enterprise value basically adds in debt and then subtracts out cash to kind of give you a better value of what the company is. And this type of multiple really gives me a good idea, taking out a lot of the non-cash transactions to see where it's at. And you can see, I would say for average for this company, it's kind of been in the 7 range, and that's where it's trading at right now. So I think it's actually not trading based on this type of multiple at a good valuation right now, kind of average, I would say. All right, so next up, we're going to go take a look at my 3 different valuation models, and then we're going to come back to my presentation. I'll kind of give you an expected return on investment based on today's price. So let's go do that now. All right, so first up is my earnings per share valuation. What I try to do is look at the trailing 12 months earnings per share, see what that is, and then see if that makes sense to use or not. And I would say most of the time it makes sense to use. I would say Foot Locker, it doesn't make sense. The earnings per share is over 9. And from a historical standpoint, that is really, really high. I do think, switching over to e-commerce, selling online has helped, but also the gain that they had from their non-cash sale. So I think a good earnings per share for this company to be conservative is around 6.5. And now as far as growth rate goes, so what is the growth rate for earnings out the next 10 years? And what I tend to do is look at historical numbers, and I also look at what analysts think. If we go back to the metrics I showed, and if we look at earnings, it's been going down. So you can see over the last 10 years, or the last 7 years, it's been going down. So over 7 years, it's gone down 3% per year. I don't think that's going to continue to happen. I think hopefully with the e-commerce and the higher profit margins they can hopefully utilize with these 2 new acquisitions, I'm going to give the benefit of the doubt to management and say, hey, you know what? I think they can probably keep up with earnings based on sales. And sales has been around 6%. So I'm going to use 6% as my number. This is very subjective, very, very subjective. People could use different growth rates that they deem, correct or not. So I'm using 6%, so I personally feel that this company is worth. So based in 10 years, I think that the future EPS should be around $11 and the future stock price should be around $139. So based on a 10% return, I estimate the sticker price right now should be at $53. And some people may ask, why are you using 10%? You know, you've been using 15%, and this is something new I'm going to start doing going forward. There's a book out there from Nick Sleep that I found very, very valuable. And what he does to value companies, he uses a 10% return because that's what you'd want for return on invested capital. So when I talked about my key metrics before, return on equity, return on invested capital, I want 10% per year. So that's what I'd want or expect from this company. And then I'm trying to find out, how much margin of safety I have from there. And I'm trying to get, minimum of 30%, hopefully for 50%, depending on the business. And right now, based on that, it's only a 12% margin of safety because I think it's worth about $53 right now, based on that 10% rate of return, and the stock is trading at $48. So next up, let's go take a look at my 10 cap valuation. And what I'm doing here is I'm trying to get total owner's earnings of the company, basically trying to get their free cash flow, which is cash from operations minus capex, adding in the tax provisions. Now, they had a lot of weird stuff going on in 2020 and even this last year. So I'm trying to normalize it the best I can. So I feel that operating cash flow, a good number is around 700 million, about 150 million for capex, about 175 for tax provision, which gets me to total owner's earnings of 725 million. I divide that by total shares outstanding, 104 million. I get to roughly $7 owner's earnings per share, and I want to pay 10 times that. So it's $70. So in layman's terms, what I'm trying to do here is trying to buy a business based on free cash flow and be able that company basically generate a 10% free cash flow per year based on the total value of the company. So I get my money back in less than 10 years. That's kind of what I'm looking at here. So based on a 10 cap valuation, that's $70 per share. So that's looking really good. That's a 30% margin of safety based on today's stock price. So now let's go take a look at my discounted free cash flow model. And here what I'm trying to do is I'm trying to calculate what free cash flow is going to be the next 10 years and then discounting it back to today. So today's stock price is the net present value of all future free cash flow. So what I'm doing here is projecting out about 6% growth. I'm also using a multiple of 8 because this company does trade at a lower valuation compared to the market. So based on that, I come with an intrinsic share price of $56 a share, which is roughly about 18% margin of safety. So 18% margin of safety for discounted free cash flow. I got a 30% margin of safety for a 10 cap, and then roughly about 12% margin of safety for my earnings per share calculating out. So now let's go back to my presentation and talk about what I think return on investment for this company is based on today's stock price and other future stock prices. All right, so before I show you my return on investment, what I would expect for this company based on today's stock price, I do want to notate a couple of things. So first off, I'm not a financial advisor. This is just how I'm looking at the company. Each investor should do their own valuation and digging into the company to figure out what they think the intrinsic value is. This is just how I'm looking at the company. Very subjective for each person that looks at it. This does not include any dividend payments, does not include any share buybacks or additional share issuance. So let's get right into the table here. So today's stock price is $48 a share. So it's kind of right in this area right here. So based on $48 a share, I would expect around 11% return on investment per year for this company going out the next 10 years. Now, if the stock were to drop down to say $22 a share, I would expect around 20% per year going out the next 10 years. So that's kind of how I'm valuing the company. Certainly even at 11%, I think this is better value than the market in general right now. And certainly if they continue doing dividend payments and share buybacks, that number would go up. But that's how I'm looking at it. Next up, let's take a look at risk associated with this company. And first of all, I think their business model is very risky. They're very mall dependent. I mean, most of their stores, 3,000 stores, are in the mall. And so foot traffic is obviously very, very important. Last year, foot traffic wasn't there. It certainly has started to come back. Being in the mall, depending on foot traffic, and then also typically margins are not as good as companies being in the mall. Now, this company does historically have better margins than most companies, but I don't like being dependent on the mall in general. Now, they have a low number of suppliers. They only have about 5 suppliers they get all their footwear from, Nike being 75% of that. If for some reason, if they had any kind of altercation with Nike, that could be huge. I mean, it could put them completely out of business. They also get no discount from their suppliers. Believe it or not, I found this really interesting when I was doing my research, that Foot Locker and all these other companies that get footwear from Nike, for example, they all buy them at the same price, or roughly the same price. Companies don't get a discount. And even though Foot Locker buys really more Nike stuff than anyone out there, they get no discount associated with that. So that's kind of interesting. Financials, it's very slow sales growth. They have negative earnings, negative operating income over the last 7 years. Very unpredictable. You can see the earnings up and down all over the place. So it's kind of hard to project this company, I personally think. Competition is really strong. So a lot of different sporting goods stores that carry Nike, Adidas, that they compete with. And then also acquisitions. How well are these recent acquisitions with WSS and Atmos going to do? Hopefully that brings value to the company, especially the ones out in Japan, to give them more of international impact there. But certainly a risk if they can't integrate this company, these companies well going into the future. All right, so now let's take a look at my analysis summary of Foot Locker. And first of all, let's talk about the good. So financials, strong balance sheet. I mean, their long-term debt is virtually nothing, $1.6 billion in cash. Now, $1.1 billion that's going to go away with the acquisitions, but it just tells you how well the companies manage their money to be able to buy those companies with the cash on hand. Strong margins, high single digits, which is really good for retail. Shareholder minded, they're a strong dividend payer. They historically have done a lot of share buybacks. Slow sales growth, around 6% per year. Negative earnings, negative operating income the last 7 years. Their business model, I'm not too keen on, mall oriented, and very dependent on their supplier, especially Nike in particular. All right, so now we get to my stock grade, and how I grade this is a thumbs down if I expect the return on investment, under 8%, thumb sideways if it's between 9 and 14%, thumbs up 15 to 19%, 2 thumbs up over 20%. And I think Foot Locker's a thumb sideways. I said 11% is what I expected from this company per year going out the next 10 years. Again, that does not include dividend buybacks or dividends or share buybacks. But I give a thumb sideways for this one. All right, so that was my analysis of Foot Locker. I know these analyses are long, but I feel like I can't do that in 15 minutes. So hopefully you guys enjoyed this. If you get some value out of it, please hit that thumbs up button. Really helps out the channel a lot. If you haven't already and you enjoy this content, I encourage you to subscribe to my channel. All the videos I've been doing here lately and going forward will be long, will be very, very in-depth on the companies that I'm researching. And these take 3 to 4 days for me to put together because it can be around 15 to 20 hours worth of research that I do. Future topics I'm looking into, Hewlett-Packard, Ford, Hingham Institute, Huntington Ingalls, and Amazon. And if there's a company that you would like me to look into and do analysis on, throw it down in the comment section. I read every single one of those. So thank you so much for watching. I really appreciate it. I'll catch you guys on the other side. Take care and God bless.